Hello and welcome to another episode of the Lending Podcast. We are your hosts. That's Jeff Jones.
Hello.
And I'm John Burnham. Thank you for being with us today. And we have an interesting topic for you.
Yes.
We're going to talk about some non-traditional financing and specifically loans for borrowers and buyers that do not have a social security number necessarily. They have an I.T.I.N. number, also called an I.T.I.N. loan.
Mm-hmm.
So, yeah.
They are exceptional people and exceptional loans. So I'm doing a play on words for what that means is we have to make exceptions for different things that are non-traditional, right? So when there are, financial agencies out there like Fannie Mae and Freddie Mac that oversee a lot of qualified mortgages, there's a bunch of lenders that will operate outside of those guidelines, and we call them non-qualified mortgages or non-QM. And there's nothing wrong with them other than they just don't have that oversight. So that allows them to go beyond the traditional lending practices and have different guideline sets of rules. They still have to be financially secure, and they still do have to do their own risk management. So it's not just the Wild West. But there are other available products out there that a lot of people don't know about. So I'm happy that we're here talking about it today.
Yeah, and so many of these new programs emerged after the financial crisis of 2008, 9, and 10. Coming out of that, there were lenders that realized there's a need for non-traditional financing, especially for clients and buyers and borrowers who can put down a significant amount of money. And so I think if we all remember 20 years ago, we got into this financial crisis by giving essentially 100% financing across the board to pretty much anybody out there who could fog a mirror. And that led to a massive meltdown and a financial crisis, brought this country to its knees, essentially, in 2007 and 8, and then took a long time to recover. And so coming out of that crisis, there's so much mortgage reform. You touched on Fannie Mae, Freddie Mac, the tightening of guidelines, the restrictions that were put on us as originators in the industry to verify that a borrower has the ability to repay their mortgage. So we call that ATR, the ability to repay. And you touched on qualified mortgage versus non-qualified mortgage. You could argue that some of these non-qualified mortgage programs sort of mirror what used to be a subprime loan. We don't call it that anymore. It's a non-qualified mortgage because the subprime was sort of synonymous with high loan to value, no down payment, poor credit, just a lot of issues that really caused some of those loans to default back in the day. So we're going to highlight a program today specifically where you do have to have a substantial down payment, maybe 20% down. However, you do not have to be a U.S. citizen. You do not have to have a social security number, and you don't even have to be, quite frankly, in the country legally in order to purchase a house.
It's amazing.
It is amazing.
So for those of you that are out there that are looking to buy a home and you're like, I'm never going to be able to get a mortgage because of the things you said, this podcast is for you. And if you're a realtor out there and you get borrowers that have been turned down by banks, credit unions, whatever else might be out there, but this person, it'd be better for them to own. They have income, they have a little bit of assets to put towards the property. These non-QM programs might get them into the home.
That's right.
And so we love not telling people no. We love road mapping how to get there. And this is one of those out of the box kind of scenarios. So this is good. So let's get into it.
Let's dive in. So let's identify what an I.T.I.N. is at first. So it's an individual taxpayer identification number. It looks like a social security number in many cases, but starts with the number 9, which essentially allows someone to work here, file their income taxes, pay taxes in the U.S., but again, they may not be here with legal residency status. And of course, in Texas, we have many clients who are in this situation, and they might have been here for 20, 30, 40 years, running a business, owning working as a W-2 employee or running a business, and may feel that there's not a loan program out there for them because they don't have U.S. residency status. And it's just not true. Now, there are some caveats. There's some requirements, of course, and there's some qualifications that make it a little tougher sometimes for these buyers to qualify. And it mainly comes down to assets, with putting 20+% down and we do need to have a 660 credit score in many cases. So there's some credit requirements, there's some down payment requirements, there's some income requirements. You're still going to qualify with your income as if you were putting 5% down or 3% down on a sort of a qualified mortgage or traditional mortgage. Same kind of guidelines. It's just a specific category to help these home buyers that may not have legal residency status or a social security number.
Yes. So we do have programs that do allow for no credit scores. Today, we're talking about the I-10 program, like we've discussed.
That's right.
This one does require one. So that is one of the requirements for it. It has a couple other requirements that we can go over.
Yes.
We have our cheat sheet in front of us because
That's right.
we have a lot of different options for people, and we don't want to get this one wrong.
That's right. And there's a laundry list of guidelines. Yeah. And again, every situation is going to be a little unique and to be different. So we want to go through and qualify our clients individually based on their situation. And but this is a case where we've had lots of clients where maybe one spouse is a U.S. citizen or a permanent resident, and perhaps the other spouse is not and has the I.T.I.N. number. That's okay in this situation. So you could have a couple or two different borrowers that one's a citizen and one's not, or of course, one or a couple who both are not the citizens. That's fine too. And so we're going to put this picture, we're going to paint this picture for you of what it may look like for a buyer coming in, having a conversation with us. We're discovering that, okay, they're using an individual tax identification number, which, by the way, most banks immediately will say, sorry, can't help you.
Yeah, they'll say, oh, your social starts with the number 9. That's not a social. For us, we have this program.
There's options, for sure, for sure. So let's kind of go through some. So the first thing is we've identified what an I.T.I.N. is. Okay, we know that it starts with the number 9 and not a regular social. The maximum loan to value is 80%. So you're going to put 20% down. Believe it or not, we can do loan amounts up to $1.5 million on this program. So huge loans to buy basically a $2 million house on this program, right? If your income supports that. Again, these are not stated income loans, or these are not no income loans. These are verified income. We're still going to verify tax returns, W-2s, 1099s, things like that. Self-employment's okay. W-2 is okay. And the minimum credit score, as we touched on, is 660. Now, here's something that a lot of our clients don't understand or haven't realized is possible. You can be an owner-occupant on one of these programs. You can also buy a second home on this program, vacation home. You can also buy investment property on this program.
It's not just a primary residence loan.
That's right. That's right. Which is really cool because there are a lot of our clients out there trying to build a portfolio of real estate. And I had a client recently who was able to qualify on a qualified mortgage. He had a social and had a credit score and had built. But he had built a business. He was in the landscaping industry and bought a home for his crew to live in. And it had a half an acre so he could store his trucks, he could store his equipment.
Smart.
And it was a brilliant, he actually put it on a 15-year fixed so he could pay the mortgage down faster, just really cash flowing. There's a lot of industries like that where the cash flow is substantial. And you can also look at even bank statements for income on some of these programs. If we don't have all the tax return data, we can look at bank statements. We can look at 1099s as well. So alternative means of qualifying, there's just 1,000 different ways to structure these loans. And so those were some of them. Also, gift funds are allowed. So let's say you have a little bit of down payment, 5 or 10%, but a family member can supplement that to get you to 20% down. That may work for you and something we can discuss as well. So you don't have to have the 20% down sitting in your checking account.
Right. And so, and if, I'm going to circle back a little bit on credit. If you are concerned with, not establishing a lot of credit lines for your, to get to that, you're like, oh man, I don't even know if I have credit.
Right.
We only need 3 active trade lines.
And can rent be one of those trade lines? Verification of rent. I think we can use rent.
Yeah. So there
as
are
a trade line.
So there are what's wonderful with these programs is they allow exceptions even within their guidelines. So that if we need to add that as a third trade line, that might be an exception we can get approval for.
That's right.
So sometimes we have to ask, the underwriters of like, hey, can we also use this line item as an additional trade line for an exception? And so what that means is it's a little bit of gray in some of these. And so Also, instead of if you've had 2 trade lines for 24 months, that also works. So it's not just 3. It's 3 trade lines in 12 months or 2 for. When we talk about trade lines, that's like a credit card, that's
Car
like a
loan.
loan. Yes. So if you've not ever built credit and this is the perfect program for you, and having just grabbing a couple trade lines and using
Yes.
those for 12 months is the way to go, or having 2 and we can verify your lease agreement. So there are ways to build that pretty quickly.
Yes, and we can help you, guide you in the right direction on building credit if that's something that you're looking for. And I will say this, a lot of clients that fall under this category we've had referred to us are Spanish speaking or would prefer a Spanish speaking loan officer. We have someone in our region, a Spanish speaking loan officer who can help our clients that would rather have a Spanish Spanish as their first language transaction. There's a whole nother language when you're talking financial Spanish. I can speak. I was a Spanish minor back in college,
Oh
but
my gosh.
I don't think I could get through a loan application in Spanish. That's a
Yeah.
whole nother vocabulary. So Mario, our loan officer down in San Antonio, he's amazing, and he can help
Oh, Mario.
with our clients that are Spanish speaking. So a lot of our clients fall into that category, and we want to take care of you. We want to service you as best we can. So yeah, so you touched on the credit requirements. I think that's the biggest thing is you've got to establish some credit if you have not already for this particular program. And as Jeff touched on, we have other programs that do not require credit scores. However, under the I.T.I.N. Individual Taxpayer Identification Number program, you would need at least 2 scores, with the middle score or the lowest score being a 660 for this particular program. So,
So that's one. If you're not there, we can roadmap how to get there. If you are there, great. If you're now, let's talk about another one. The 80 LTV means you need 20% down and then some cash to close as well on top of it. If you're having trouble getting there, gift funds are allowed.
That's right.
And so you want to talk a little bit about, so like credit's problem, we talked about that. We can overcome that, help you overcome that. Down payment, there might be ways to help overcome that too with other resources around you like family or friends. So what does gift funds look like?
Yeah, gift funds, what we like to see is an immediate family member, so mom, dad, brother, sister, possibly aunt, uncle, can wire those funds directly to the title company. We have a gift letter that the donor of the funds will sign. We have a gift letter that the buyer will sign. The gift funds are specifically for this particular real estate transaction. It has the property address on there. Here's the actual house that we're using the gift funds for to help purchase. And then the seamless way to do that is to have the donor of the funds wire those funds directly to the title company. And we get a wire confirmation from the title company. It's just seamless. That way the funds are not going from the donor to the buyer to the title company. It's just one less step there to document. Documentation is so important in our industry, and documenting the flow of that money is really critical. And the main reason for that is we want to prove that those funds that the buyer is using, it is not a loan. They didn't go out and obtain a loan for $20,000, $30,000, whatever, borrowed the down payment to then put down on a house. You've taken on more debt in that instance. So that's why we verified those gift funds. Same with traditional loans as well. When it comes to gift funds, conventional loans, FHA loans, even VA, we're verifying that the donor has given those funds either directly to the title company, or we've documented the paper trail from donor to buyer to title company. So very similar guidelines when it comes to gift funds and just documenting that. In other words, you can't show up to closing with a duffel bag full of cash. That just doesn't work. Title companies can't accept that. We cannot accept that as proof of where your money came from. So it's got to be documented. And I think for a lot of folks, that's maybe the toughest thing, because money does move so quickly in this industry, right? We're transferring from account to account. Maybe you're in a cash business, or you have a side business that you make cash income from, whatever that line of work is. And so we want to be able to document that is your source of down payment.
Now, and the reason why it's family is because when it's somebody else outside of the family, it's hard for a financial institution to know if that's just an investor.
True.
Right? But what's wonderful with the I-10 program is you can have a co-borrower also on there that doesn't live in the residence.
That's right.
So it's we call them a non-occupant, right, co-borrower. And so if you, instead of like, hey, my family doesn't have it, but my best friend does, and they want, this property for me, well, we just put them on there as a co-borrower.
That's right.
So it's not difficult to do that. I mean, we do need to still verify their information, because they're going on the note.
Yes.
But, it's not a hard no.
That's right. Right. The non-occupying, that's a good point. The non-occupying co-borrower needs to meet the credit requirements.
Right.
They need to meet the trade line requirements, having 2 trade lines for 24 months or 3 for 12 months. They don't necessarily need to be a permanent or non-permanent resident alien. They can be an I.T.I.N.
As well.
non-occupying co-borrower as well. They can be a U.S. citizen. So that the co-borrower that's not going to live in the house also has some credit and income requirements. And we want to make sure that their debt load, the non-occupying co-borrower's debt load, is not adversely affecting the qualification. They're on there to help the borrower qualify. So if they have a lot of mortgages or a lot of car payments or whatever, sometimes that non-occupying co-borrower's debt can be significant. Now, if their income's significant where it helps, then it doesn't matter if they have a lot of debt because the income's there. But we're going to look at that holistic picture as the borrowers together.
So we see people adding non-occupant co-borrowers because A, they need their money, to help with the down payments, or B, they need their income to help with that affordability.
That's right. That's right. And if it's just contribution of assets, then a lot of times we'll just do the gift. And
100%.
they don't have to necessarily
path
be on
of least
the loan.
resistance.
Right.
We're a big fan of the path of least resistance.
Yes, for sure.
We're good.
So that's a good overview. I mean, there's a lot of little nuances to these programs, and I think in addition to not just the I.T.I.N. loans, but just alternative financing options in general. There's so many different ways to look at these loans now, with either using bank statements or 1099s. Yes, you having tax returns is the more traditional way to qualify. But if you don't have tax returns out there, you may still be able to buy a home. And we just have to unpack all those pieces. Mainly it's credit, income, assets, what we kind of talk about all the time. We meet those requirements, there's usually a way to get it done.
Wonderful.
Yeah.
Well, if your identification number starts with the number 9 because you're exceptional, we hope that this has been helpful for you to realize homeownership is possible. And there are programs for you that are specifically actually catered for you out there. And so here at the Lending Podcast, we have a wealth of knowledge that we've been recording already about all of our programs. This is one of them, but please like, subscribe, share. Do you have any other sending words off to people out there?
The market's shifting right now. Here we are, we're at the end of summer 2024, and we've seen interest rates come down. Some of the loans for these programs, the interest rates will start coming down, we believe, in the next few months as well. I had a bold prediction last podcast that the Fed will be lowering rates. It looks like it's leaning that way, although there's some controversial commentary out there.
I would say making bets, but that might be illegal. Is it going to be 25 bips? Is it going to be 50 bips?
We can have a gentleman's bet on it.
We'll do it. We'll talk on it. We'll talk offline.
We'll bet, yes. We'll bet lunch.
Lunch is good.
Right. That sounds good. Well, we look forward to seeing you. Thank you for being with us today. We look forward to seeing you again soon.
All right. Take care.